Hey everyone, Michael Beresford here from OpenCorp, along with OpenCorp CEO Matt Lewison.
Howdy, good.
Excellent. Well, we are coming towards the end of financial year. It's fast approaching, who can believe it? Seemed like Christmas was yesterday. But end of financial year means tax time. So this episode is going to be dedicated towards tax. From helping investors over the last 15 years grow their portfolio, I think nearly everyone has heard of tax benefits, or at least the term negative gearing. A fraction of people actually understand what it means. So we're going to be unpacking how property works with tax benefits these days and how it can be effective, Matt. So maybe kick off. What does the tax landscape look like? And if we're looking for incremental advantages here and there, how does tax play into that?
Yeah, I mean, it's obviously critical. And one of the things that I guess when you talk about tax, we have to understand why there are tax advantages to owning property in particular. Because the way the government works is they really try to line up incentives to get people to do the things that they want you to do. And clearly there's an advantage for the Australian government for property investors, for Australians to acquire investment properties, and particularly to build new investment properties, because by building new investment properties, we're adding to the housing stock for our growing population. So they structure the incentives in a way that really encourages people to build new and rewards them for doing so. And they do that through, I guess, a couple of mechanisms. One is by giving you the ability to depreciate the value of a new building, and obviously the value of the construction. If you're able to depreciate that, as well as the fixtures and the fittings that have gone into it, which get depreciated over a couple of years, then it gives you more tax back. And they do that by reducing the amount of your taxable income. So if I've held a property that I've recently built and there's $20,000 of tax deductions that I can claim in a year, and I was earning $100,000 from my PAYG, now when I go to do my tax assessment, it's being assessed on $80,000 of earnings, and I might have overpaid in my PAYG ongoing payments to the tax office, so I get some of that back in my pocket. And that's one of the real key things, and obviously I've talked about depreciation there. But this applies to other expenses you incur for your investments. Again, because the government wants you to invest, it's good for the economy, it's good for the population, it has a social benefit as well. So they want you to invest, but they know if you incur an expense for that investment, then you need to be able to reduce your tax. On the flip side, if you earn an income from an investment, then that's going to add to your tax. But the balancing effect, and this is where we get negative gearing, is that we get the benefit of reducing our income by the amount of any interest that we're incurring, as well as reducing our income by the amount of any depreciation or amortization of fixed items within the house. And that generally, because of that depreciation, and we call, what's it called, like phantom cash flow, that you're actually not incurring the expense, but it's reducing how much tax you're likely to pay. And that puts more money back in your pocket. And when this becomes really, really powerful, and investing is a game of inches and using every little 1% to your advantage. So it's one thing to claim those tax deductions and do it in your annual tax review, and a lot of people leave that until the last minute, so maybe next March they'll be doing it for this financial year. But if you do it at the start of the year, and this is a bit of a novel concept for a lot of people, that you can actually do your tax return essentially at the start of the year, start of the financial year, and you send it to the government by way of a PAYG withholding variation. And the government then sends a letter to your employer saying, hey, don't take 37 cents in the dollar out of this person's pay, only take 20 cents in the dollar out of their pay. So you're actually getting the benefit of all those tax deductions every month or every week, however often you're paid, for the full year. And the benefit of that isn't just that it's giving you more money now, it also allows you to pay your mortgage down faster. And by doing that, you're getting the benefit from paying less interest in the future, and it has a compounding effect. And again, there's two 1%ers that when you do it, what's that, 2.2%, I guess, in the, So yeah, it's about using all of this to your advantage.
Yeah, I think one of the things that's not well understood is the mechanics of how those tax benefits work, and especially what we're finding with clients is that in the last 3 years with interest rates at record lows, 0.1% cash rate, the rent covers not only the loan interest, but all of the other costs of holding a property. With such a steep interest rate increasing curve, obviously getting those tax benefits, fortnight to fortnight, week to week, whatever pay frequency they're on is a game changer for cash flow. So, if you might have seen some of our other episodes, specifically one that we did on exit strategies, where we talked about only needing a small but effective portfolio of, say, 3 or 4 properties held for the long term. If you're smart and getting those tax benefits drip fed to you throughout the year, then it means that you can hold double or triple sometimes the number of properties for exactly the same money out of your pocket as if you were waiting until tax time to get your tax return back. So perfectly legal, just not well understood, little 1%ers that we talk about for investors. And especially the depreciation, because with build costs increasing, obviously the depreciation benefits are turbocharged. Think of someone on that 37-cent tax bracket. You're effectively, and your build cost is, say, $400K for the build. There's $150,000, give or take, that the government is effectively giving you over the life of that property. Sign me up for that. Where do I get that, as well as an asset that has more tenant appeal, more ongoing tax benefit as well, less maintenance risk and so forth. So there's a piece on tax. Hopefully that's been helpful for you. Examples are always a really, really good way to be able to get your head around these concepts. So click on the link below. We've written an article. We've mapped out how the tax benefits work for you and how you can use tax benefits to your advantage to turbocharge your portfolio. Michael and Matt, we'll see you next time.